The S&P continued a nice run here. It's nice bullish trend with a good move today. Nice solid move up to the upside, led by the traditional, at least the more recent culprits that have been pushing equities higher, especially the nice reward that we saw on Nvidia today. Seems to be the market's has kind of shifted from following what like Apple is doing and is following more what Nvidia is doing, especially coming after, which might actually be one of the brightest spots that we saw today, is the market's reaction to the CPI report earlier today. That what was a decent inflation number that actually caused rates to continue their kind of their bottoming out process into a new move to the upside. Didn't phase equities, and nor did the move higher in the dollar phase equities. And that's traditionally has been, those two asset classes when they rallied, that's put pressure on stocks. But again, thanks to the move that we're seeing in Nvidia, that was not the case today. And so we're going to talk about kind of the patterns we need to see in the equity markets for this trend to continue. We're going to take a look at how other trends of similar strength have consolidated in the past, and again, what we continue to need to see to avoid such a consolidation here in the future. So we'll break all that down, kind of what we expect to see, how much longer we expect to see it, whether there might be some records broken. Again, there already have been some records broken. We might see some more records broken here in the very near future. And then we'll talk about kind of what's driving that. What's not driving, I guess, would be kind of an interesting discussion point in today's sector rotation moves. And then our trade idea as a stock, again, kind of outside the traditional area, but it has been one of the more recently hotter sectors, breaking out into what can be a very good, potentially good directional move. We'll talk about why and how we traded that. So let's go ahead and get started. Today is Tuesday, March the 12th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I review all the trades that we've done in past videos. We've also put on today's trade already before the market closed in this class. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there that pops up. There you go. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask. It's a big deal for us. So our goal is to get to 100. We are still in kind of the 60s here. Our next goal is to get to around 70. So thank you to those who like these day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line jumped back up above. After one day just a smidge below the market sentiment, we are easily back up above the market sentiment line. And now both are rising again. As you can see, rising here. So intermediate line joint coming back up, market sentiment up. Again, we've been above 80 now for quite a bit, with a brief little pause here for quite a bit of time. The near-term line coming back out of bearish territory, back in the upper half of the chart. Momentum line up in the upper reversal zone, which is a good indication that the near-term line will probably also get into the upper reversal zone. It's not too often. Here's a time that it didn't. But it's not too often. You can see more the other times. When the momentum line got up there, the near-term line followed suit. Sometimes the near-term line might get up there without the momentum line, but generally speaking, if the momentum line gets there, the near-term line also gets there. So a good chance that the near-term line will, which it actually needs, because again, the last peak, we don't want this, right, where we had two straight peaks of the near-term line below the reversal zone. Now, the second one didn't have the momentum line jumping into the upper reversal zone itself. So that's the difference so far as what we're seeing right now. We also had an extreme low on the momentum line in between, and we did not get that here. So maybe there wasn't just as big of a move from up to down. Maybe it was because we were so extreme to the downside that it jumped up so much. It remains to be seen. But as of right now, the strength of the trend is still there. Obviously, no cluster, right? So sometimes you worry about that momentum line getting in the reversals. It doesn't stay there for very long. It might stay there for another day, but what you don't want to see is this, another cluster, right, where the near-term line also gets there at the same time that the momentum line does. And as of right now, that's not the case. So we're pretty good there, but a really good move on the day today. The NASDAQ 100 has a little bit more room to get back above market sentiment, but at least it bounced. The short-term sentiment's not as much of a bounce. It's still in the near-term line, is still in the reversal zone. The momentum line is not in the upper reversal zone, so we're still prone to another bearish near-term peak on the NASDAQ. So keep that in mind, even though it was up 1.5% today. Looking at your Dow Jones Industrial Average, it wasn't up as much. The near-term intermediate line avoided falling out of bullish territory. It turned back up. Strong short-term sentiment. Again, the momentum line did get into the reversal zone, so a good chance that the near-term line will as well. And near-term line has crossed above the intermediate line, so that's a good bullish sign. Kind of a bounce off of this bull tag so far, so that's good. A good sign for the Russell. And then finally, your Dow. The Russell was actually down. It did finish off of its lows, but the near-term line actually got into, at one point in time when we were at the lows, the near-term line was actually at extreme lows too. So at least we bounced off those lows, and it doesn't look as bad. The near-term line doesn't, kind of similar to like this pullback right here. So kind of hoping that we can get a similar bounce now off of this that we got there. Your intermediate line is still in the reversal zone. Your market sentiment line is still in bullish territory. So there's still a good chance that we can, just bounce off of this low point and come back up. So, and in fact, that's kind of what you would expect until we see something different. That's what we're seeing so far in the large cap indexes, and what you'd expect to see here on this one too. The weekly chart, again, because of the rally, now we have a higher close. Again, we have 3 more days left, so the weekly chart's not done, but this would actually be really good. Now it's a lower high point, but again, we have 3 days left to get a higher high. So that's, we're still, now that we have a higher close, we are converging. We're back in the 90th percentile of this, past 3 years. We're back in the 90th percentile here, above the 90 in terms of how big this gap is. It's pretty sizable, pretty sizable move. But as of right now, it's still a bullish candle. So, it is a long bullish trend, right? 20 weeks or whatever. But until it dissipates, right, we can still ride this as long as we possibly can. That's the ultimate goal, is to try to ride the trend as long as we possibly can, and hope that, we avoid this again, because, again, as much as deep as that was, because of how bullish this is, we got a bigger gap to fill now than we even did there. So we want to avoid, we just want to continue to ride up this 10-week, for as long as we can. You can see, there's precedent for getting up above and staying up above there in 2021. When we came off, we had a couple little pullbacks just below the 10-week, and then we bounced right back up, and we stayed up above here for a long time. That's the kind of move. This kind of move right here was about 20 weeks going into pre-COVID, and you can see 2017, the entire year, we stayed above, and a pretty good, decent long run in 2018. So again, that's, we've already had a pretty decent long run now, but it can, if we can get it to, maybe with a little tiny decline with the red arrow, kind of like, this one here in 17, that would be the ideal scenario there. And I know our, again, we're also in the 90th percentile of the last 5 years, and we're pretty high, relatively speaking now, similar to the COVID peak, similar to the early 2018 peak, and similar to this peak. That's the problem, is like all these other periods I've shown you, they all culminated in peaks that are all actually lower than the peak we have right now. So it's unlikely that we would get, because it's been so much of a move, it's unlikely that we'll just get a little decline with the red arrow. So when we decline, it probably will be a move back, like all these others, where we actually did get down and touch the 200 week. We went past the 200 week, went past the 200 week, and then ultimately touched the 200, went past it a little bit. So, so that's if we decline, that's the kind of move we are likely to get. So if we can avoid it for however much longer, the better, right? The better the case scenario there. 3 green arrow chart, you can see we don't have 3 green arrows in any of the indexes. The Russell has 2 reds. We have 1 red on the diamonds. We have 1 red on the spiders. We have 1 red on the Qs. But we don't have 3 greens yet on any of these. And the momentum's not going to be very big. We had some pretty negative momentum on the diamonds. But all the other negative momentums have been pretty flat, which means it's probably going to be pretty difficult to get a significant bullish momentum going. So it's more of just a continuation of a grind like we've had over the last so many weeks. Looking at the 2-line version, you can see again well above the 8-day moving average. MACD is still above its moving average, so we're still good there. IWM is flirting with being below its 8-day. The Qs is back up above its 8-day, and then the diamonds easily back above its 8-day. So nice little rebound above short-term moving averages there. And so let's take a look now at some of these other oscillators here. You can see we are still above 60. Great, right? Still above 60 here. Still above 100. Still easily above 0. So again, the more we stay up in these upper levels, we avoid, because once we get turned red, we're going to be red for a while. So we don't want to be red, right? We want to stay green as long as we can, and that's kind of what we're hoping on. I mean, this, it won't be green forever, of course, but we want, nobody likes it to be red. Whoops, why did I do that? So as long as it stays up above 50, as long as it stays above 0 without dropping down to like minus 150 or anything like that, then we can stay and you can see we've had extended periods of it being green, like this over here when we came off of this June low point, and in a few instances over here as well. Really, when we came off of that low point, we had a few instances where it got below 50, but never really got below 40 until, that was a full 11-month period. I think that's the kind of move, and you can see we've been, at least during that period, we had a few instances where it dropped below 50, just never got below 40. Over here, we haven't even gotten below 50. So this has been a long period of time without even just a little dip below 50 here on the RSI. So it goes to show, and it's the same thing that you see here on this. It's kind of similar idea, similar premise. We haven't dropped. We're back above the 90th percentile of where we're closing up. We're closing off of this 51.89 high, but just what, 14 points or so, and that gives us the 95th percentile. We're pretty darn high here, back above the 90th, making another run. We haven't been below 50 except for one day, and it was barely below 50 for months. So again, the longer it can stay, and for some perspective on how long that can be. You go back to that same 2021 period. We did have a few instances where during that time frame, after we jumped off that October low, got above 50, we dipped below 40 even there. We dipped below 40 a couple of days here. We dipped below down to extreme lows on this May 21st. Dipped below 50 there as well, got into extreme. So we had instances where we did dip below 40 even before jumping back up and staying above that moving average. So here we haven't even done that. So this has been a long period of time and also another way of looking at it, when you look at the Bollinger Bands, we've been in the upper quartile for a long period of time here. Again, you look at, for some perspective on other periods like that 2021 period here, we were also in the upper quartile. We had dips below. So we had to dip down into the lower quartile there, a few other instances. We've only really dipped barely below the midpoint, that 20-week exponential moving average at the beginning of the year, and that was it. Otherwise, we've been in the upper half of the Bollinger Bandwidth and in the upper quartile for a good chunk of this period of time. And the bandwidth hasn't been too big. It's been relatively low, and that's what happens when you're this bullish for this long. You're going to end up relatively low, and your upper band is going to start coming down. We're not quite there yet. This is the size of the bandwidth, and it's been, how many days has it been since that peak of the bandwidth there? So it's been 109 days since we peaked on the bandwidth there. So we still have, it's a 150-day range of what these dots are telling us. So we still have quite a few days that this upper band is going to be up here before it starts to ramp back down and lower back down, which it usually does. It lowers down when you're on these bullish moves. You can see when we were on these bullish moves here even, it started to ramp down, because usually it's actually a move to the downside that makes the 150-day high. The fact that it was an upside move that made the 150-day high is kind of what makes this move very rare, this bullish move very rare. Let's take a look now. You can see we looked at the RSI. We didn't look at the DMI. Let's take a look at that again. Again, back up above 40. Remember, we don't stay above 40 very long, but we are back above 40. We are still above 20 on the negative indicator, despite the strength. The Ichimoku cloud, you can see we are above 21 now, so we can raise this up to 21. So we are up above 21. We still have a very strong trend growing here. Your zigzag got a new number. It's up to 25.69 now. It was 25.29, I believe, before. So remember, the record's 26.33 without a 2% decline. I know this is the 5% chart, but it's the same move. We haven't had a 2% decline this entire time. It's been a long time. It's been since we had a red tag with a 2% or bigger number in it. So I believe we're going to hit it. I think we're going to hit that record here on this current move. And then looking at the Bollinger Bands, you can see we are still in the upper quartile, but we are back above the upper Keltner channel. So we got above 40 in the DMI on the positive indicator, and we're back above 40 here. So very strong move. These aren't just grinding moves. This was another very strong move. Now all the other moves that were pretty strong got you, that sparked these short near-term declines. And we'll see if, again, we kind of need more than just one day to keep the near-term line up for longer. So we don't get another bearish near-term peak, because multiple bearish near-term peaks start to, signal more towards the end of these moves. We did not get a new 4-week high point yet, but we did get a higher high, higher low, closing at the highs of the day. Very, very bullish from that perspective. Still a pretty small range. We'll see if we can get back to 100 tomorrow, so we can again avoid that green line falling below 70, and especially falling below 50. As I mentioned, the range today was slightly above average, actually 6.5 points versus 4.5 points, slightly above average in the volume. So we've had 2 out of the last 3 days that were above average with range and volume, and this one was, not both were down days, so we actually had one of these being an update. Now we are ramping up a little bit, again crossing 1% will not be bullish, so we kind of need to stop ramping up and start really slowing down with some, continuing to push higher, but with smaller moves, so we don't get above that threshold, which typically coincides with weakness in the markets, not necessarily strength in the markets. We go up with smaller ranges. The problem is we're already extremely low. At least we can go back down to 80 like we did this last period, where we almost got up to 1% on this decline. Actually a period of decline volatility, and then we ramped up, and then we started to pull back down. That's the kind of move here that we need to see again, where we go up, but we don't go up very much, so we can stay down at these low levels here. The volatility index, if you look at the VIX today, remember we had closed above the 200-day moving average yesterday. Obviously, you're back down below it. Big drop in the VIX, back below 90%, so pretty darn low. The VVIX did not drop back below 80 though. It stayed up relatively high, still above, still at 83, despite the big drop there. But we did peak close to 90 on the VVIX. This would be the lowest peak of the recent peaks. And, potentially we might be moving. We might have a leg lower now in volatility for another few days or so. You can see we're back below all the moving averages. So if we were above the 200-day, we dropped below the 200 and the 817 and 30. Probably, last time we spent 3 out of 4 days below 50. Over here we spent a couple days. Over here was 1 day. So most likely we're going to spend a day or two below 50 on the next leg lower, where we get some red bars here on this histogram. All right, big drop today in gold. As you can see, gold, which have been running up so much, really dropping pretty sharply here. Let me show you what it looks like on the 1-day range, the 1-day chart here. So give me 1 second to do that. So here's the move on the 1-day chart. You can see a big drop in gold, down more than 1%. TLT was down, so yields were up higher on the CPI report, moving up. Yields jumping up on that. Commodities were down. Strength in the dollar with those yields. So that was really the one thing. Yields was up. The dollar was up. Commodities were down. And yet, despite that, the yields and the dollar being up, which typically has been bearish for equities, U.S. equities really did well. But really so did international. Emerging markets kind of matching the S&P's move today. Was outperforming it for most of the day. And then developed markets underperforming, but still up considerably, and high yield really outpacing. If you take a look at some of these ratio charts, let's look at first of all, the Qs relative to IWM, and you can see the big move higher here. Let me just get back to a zoomed in chart. There's our move back up above the 30-day. I mentioned in my class today, if this is a one-day thing, then we're going to hold this resistance and bounce back down. But if we break through, then it's going to be more than a one-day thing. And you can see that as well when you look at the S&P relative to the equal weighted index. Also kind of sitting at some resistance here. So it's got to, if there's a one-day thing, we're going to hit this resistance and bounce back down and continue doing what we were doing. Or if we break through, then we're going to be up for a while, right? Which, again, is the more likely, the more preferred scenario here. And look at the HYG jumping up versus IEI, big move back up. Not the all-time, not the 52-week high, or I believe would probably be the all-time high for this ratio, but pretty darn close, right? We're just a week or two off of the all-time high. But yeah, it would be the all-time high for this ratio, which has a limited history from right before the last bear market here, but you can see a nice trending move up above pre-COVID highs. So it's been following the Nasdaq pretty much more than anything. It's very highly correlated with the S&P, as you can see. So as long as we were starting to show some weakness, which was a little red flag that was coming up here over the past week or so, but today reversing all of that weakness in really just one day. Let's take a look at the yields and see what they did. We were kind of anticipating that yields would make a move, start to move up, and we got that today. One of your bigger moves here lately. The near-term line crossing back up above. Well, it crossed up above it yesterday, continuing up to the upper part of the chart here again, up to the upper reversal zone today. The intermediate line turning back up, so we're back to green shading. We're still below a falling moving average there, so that's why we're yellow on that chart. If you look at the where the TNX is on this moving averages, you can see we're back above the 8-day and back above the 50-day. So we had briefly gone below the 50, MACD and stochastics are rising. So a little bit of a turnaround story there. We like that. Yield, the dollar is also turning back up. It did come off of the 8-day, and we had like an intraday drop in the dollar, but you can see it looks like it's holding some support in this area. This is what its market forecast chart looks like. Then dark pink shading and a red line, but the near-term line had crossed above the intermediate line and now is moving higher towards bullish territory, with the near-term line now dipping its toe in the lower reversal zone again. And then finally, if you take a look at crude oil has been kind of soft, but very small ranges. So very, very slow move right now. Not a whole lot of volatility. And what is generally a pretty volatile time for the contract. You can see this is the time of year, this first so many months, where crude oil actually ramps up a little bit. But we're already up on the year about as much as we almost are on average for the last 20 years. So we've already had a pretty good run on crude. But you can see this is a time of year where there is a little bit of a dip. And from this level, really from the 14th is when we typically bottom. We tend to rally up through the end of June into the end of July. So with another peak at the end of July. So we're not done with the seasonally bullish time of year for commodities, and again, you would expect that to have a positive impact on yields, but you would expect to have a positive impact on the dollar as well. And considering they're forming lows, It seemed like all three of these would be leaning. You would expect them to continue to move to the upside, and the question will be how much volatility, if any, that will create. That has traditionally, over the past few years, created volatility for the markets, and we'll see if it does again or not in 2024. Let's take a look at how the sectors performed today. So let's take a look at the sector comparison chart here. And you can see NVIDIA was the big winner. So, the market's kind of following NVIDIA's lead right now. XLK was up over 2%, the only one over 2%. The only one that outperformed the S&P. XLK and XLC underperformed S&P, though they outperformed all the other industries. And then, of course, the industries that have been working, the dollar-sensitive areas, the interest rate-sensitive areas, all lagged. They all dropped. Not only did they lag, but they dropped today. So when you look at their relative rotation graph, again, you can see real estate, utilities, energy, materials, they're still all leading, even after today's move. They're still leading. Industrials, financials, so some of these cyclical areas moving down. Communication services and technology or discretionary are still in the lagging category, but technology looks like it's trying to head into the leading category as well. And of course, a big reason for that is what we're seeing here. Big 7% gain on NVIDIA today. That's our big driver. That's what's driving a lot of this market. Apple is not. It's down below its 30-day moving average. Microsoft bounced up quite a bit today, back above its moving average after a little bit of a bull tag. Amazon staying up above it. Google still below its falling moving average. Intermediate line barely getting above 20. Adobe, Cisco kind of in the same scenario, above or flirting with falling moving averages, whereas Netflix and Meta are kind of matching or following where NVIDIA and Amazon. What's interesting is Broadcom didn't follow that 7% move. In fact, Broadcom was actually down slightly today. And that's going to be interesting to see if NVIDIA and Broadcom, if NVIDIA can keep going without Broadcom, if Broadcom starts to lead NVIDIA lower. Right, we'll end up seeing if that ends up the case. But that's our biggest reason why the market's rallied here today, is because NVIDIA was up so much. If you take a look at NVIDIA's chart on these moving averages, again, very, very strong move. MACD is very high. Big gaps there on the moving average, well above the value area. Looking at the RSI and the CCI, very, very strong levels, very parabolic. We had just gotten we were above 80, we had just gotten below 80. Now we're back above 70, which in and of itself is a very, very bullish move too. And then you look at its DMI, and not only are we above 40 and have been for a long time. You remember it's rare to be above 40 at all, but it's been above 40 now for a long time, but its ADX is still easily above 50. So very, very parabolic move, and the question, of course, is going to be if and when the parabolic move ends on NVIDIA, what impact that might have on the broader market as a whole. As you can see, the weekly DMI is even more, it's just about as parabolic as the daily is, and that just goes to show just how strong of a move this is as we reapproach that 1,000 level. Are we going to hit that 1,000 and bust right on through? Or is that going to be another area of selling that we saw last week? All right, for our trade idea today, I wanted to take a look at Archer Daniels Midland. That had a really good run here. You can see a good breakout pattern today. Intermediate line crossing into the upper reversal zone, getting more than 5% above the 30-day moving average for the first time since back here during this bullish run. So very strong move, dark green shading in the green line. Market sentiment's really low, so because we've been so bearish. You can also see that here on this chart. We've been so bearish for so long. This is the first bullish candle we've had in months on here. The PPO is so low, but it's starting to turn up from this very low level. Again, the strongest bullish candle that we, stronger than any of these candles. Again, we have to go back to over here when we had about as strong of a bullish candle that started that bullish run. So good, strong move. Obviously, you're getting 3 green arrows. You see the 3 green arrow chart there, the green shading. You can see also got above average volume on today's a little bit of a breakout move. If you look at this chart, you can see the gap on the price on that drop produce a tremendous gap in volume. So If the 50-day moving average holds for resistance, then we'll fill in today's gap and come back down to the downside. But if we were to break above the 50-day, you can see that there's not very much resistance at all. Like, we can really get moving pretty easily here as if we start to fill in that gap. A very significant move. Looking at the DMI, you can see a bullish breakout pattern there. First time we've been bullish here for a while since the last bullish run, above 30, below 20. So a good breakout pattern on that. Looking at the RSI and the CCI, you can see we were actually above 60 for a good chunk of the day today. Pulled back barely below 60 because we pulled off the highs. Finished above 200 on the CCI. So good strong move up to the upside again. We had been down well below minus 100 for a long time on this bearish decline. We're still below zero on the weekly CCI, but we're climbing out of some extremes on these weekly charts. Looking at the Ichimoku cloud, we're not above the cloud yet. We're sitting at the bottom of the cloud, and you can see we're getting early signs. We actually were slightly above 50 and above 1 at the highs of the day today. We were getting signs of a new trend developing. Looking at the not the Ichimoku cloud, the Bollinger Bands on this, we did end up closing outside of the band, the upper band. The bandwidth got really, really low, so we had been sideways for quite a while. So we were breaking outside the band and the Keltner channel. The bands themselves were flirting, probably one more day away from getting outside the Keltner channels themselves. So, with some positive momentum developing. So we actually have an opportunity here for a breakout move up to the upside. I wanted to give it some time because, again, there's a lot of potential there into that gap, but we do need some time for the timing to work out. Right? As you saw, we gapped up today. We can start to fill in. We already did fill in some earlier on an intraday basis. So what I decided to do is buy a call option at the money so that we got 66 days here. We can give it some time. We're right at the money, 50% stop order. You can see my stop order is basically back below the moving average. So we essentially have to pretty much undo the breakout, which, if the breakout does undo itself, then we probably don't want to be in a directional trade anymore. We want to be out of it. But if we continue to be above here and we start to fill in that gap there that's in between these price levels, you can see it better here. If we start to fill in this gap, then I want to give it some time so that we can be able to get up into here. You can see by June expiration, May expiration here. By May expiration, we're at 63.5 is where this can get to. That can get us a pretty decent reward, up to about $1,200 for, again, about a $500, well, a little bit more than $550 risk if we were to get stopped out at the stop order. So a little bit better than 2 to 1. Again, but that's only if we were to fill in all of this gap by that May expiration, do a little bit more, then you can kind of see the reward potential up to around 68. Now you're looking at about a $3,000 reward for that same $550 of risk. So some good opportunity here if this breakout continues and we don't meet a whole lot of resistance in this area. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody. And we'll see you all next time.